Hello everyone, welcome back to the Mr. Chang channel. In this episode, I'm going to share some of the biggest misconceptions I had during the time I was learning about trading and investing. I'll try to explain everything as clearly as possible based on my personal experience over the past few years. Honestly, I don't want these misconceptions to continue existing, or even worse, to keep spreading among people who are new to the market. This is extremely important because it can strongly influence your foundational mindset. When we learn something new, our brain is like a blank sheet of paper. If it gets filled with the wrong ideas from the beginning, the longer those ideas stay there, the harder it becomes to correct them later. You first have to erase the wrong beliefs before you can build the right ones. That's why having the correct mindset from the start is crucial, not only in trading, but in any field. The first misconception. Many people believe that most trading knowledge and strategies being shared online are correct and profitable. Now, it's not entirely wrong to say they can make money, because technically any entry point, even a random one, can result in profit sometimes. The real question is not whether a trade can win. The real question is, can the strategy generate consistent profit over time, for example, on a weekly or monthly basis? Every strategy will always have winning trades and losing trades. For any single trade, you can never know with certainty whether it will win or lose, no matter how perfect it looks or how powerful the strategy claims to be. So, with a small sample size, results are basically random. But when the number of trades grows to dozens, hundreds, or even thousands, a good strategy will show something important. Profits gradually increase over time instead of losses increasing. Even then, there will still be wins and losses. What matters is that winning trades compensate for losing trades. This relationship depends on two key factors: win rate and risk-reward ratio. Understanding risk-reward ratio. Let's say we have a trading strategy with clear rules, including trend conditions, support and resistance zones, and specific entry criteria. When all those rules are satisfied, we take a trade. For example, a buy trade. Every trade should have a stop loss below the entry and a take profit above the entry. To manage risk properly, we define a fixed loss amount per trade, which we call 1R. If the price hits the stop loss, we lose 1R. Now, if the take profit distance is equal to the stop loss distance, then the profit is also 1R. This means we risk 1R to make 1R, so the RR ratio equals 1. If the take profit is twice the stop loss distance, then RR equals 2. If it's half, then 0.5. Break-even point. For example, if RR equals 1 and after 100 trades, 50 wins and 50 losses, you break even. But if you win 51 trades and lose 49, you gain plus 2R. So with RR equals 1, the break-even win rate is 50%. The formula for break-even win rate is break-even equals 1 divided by 1 plus RR. Examples: RR equals 1 equals 50%. RR equals 2 equals 33.3%. RR equals 3 equals 25%. So if your RR is 3, you only need to win more than 25 trades out of 100 to be profitable. By applying this concept and backtesting strategies on historical charts, you can determine whether a method is sustainably profitable. And surprisingly, very few people actually explain this. Second misconception: trading is easy. In the beginning, trading looks extremely attractive. You often see images online of people making huge amounts of money in just a few minutes. If you're stuck in your current job or looking for a new opportunity, trading can sound like the perfect solution. You might hear things like, "Just follow this strategy," "Join this group and copy our signals," or "Give us your money and we'll trade for you." But the truth is, trading is not that simple. It's actually a trap for people who want fast and easy money. In reality, trading is difficult. But usually the things that are difficult are also the most rewarding. If something is easy and everyone can do it, the income from it will rarely be high. That's why high-income earners are always the minority. The difficulty of trading isn't about intelligence or background. It's about persistence. Who can stay disciplined longer? Who can endure the learning process? Every profession is difficult at the beginning, whether it's programming, marketing, construction, or languages. Trading is no different. Third misconception: copying others makes money. Many traders believe they can profit simply by following other people's signals. That's why there are so many signal groups. And honestly, most beginners have joined at least one. This doesn't mean all groups are bad, but the problem is that you don't understand the strategy behind those signals. You don't know why the trade is taken, whether the strategy was tested, how risk is managed. Without that understanding, your psychology becomes unstable. A few winning trades, you believe the strategy is amazing. A few losses, you lose confidence immediately. Why? Because you never truly understood the method yourself. Real confidence only comes from experience and practice. Fourth misconception: higher RR is always better. Many traders believe they must aim for very large R multiples like 5R, 10R, or even higher. But there's a trade-off. The larger the RR, the farther the take-profit target. And the farther the target, the harder it is for price to reach it, which means win rate decreases. A strategy with a lower RR but higher win rate can sometimes be more stable psychologically. For example, taking 1R to 2R trades daily may be more sustainable than waiting for huge targets. Also remember, making 5R per month with $1,000 per R equals $5,000 is better than making 20R per month with $200 per R equals $4,000. The value of R matters just as much as the number of R. Final misconception: demo accounts are useless. Many people say demo trading doesn't help. They think only real money creates real discipline. But think about any profession. A football player trains before playing. A driver practices before driving on the road. Why would trading be different? The demo account exists so you can practice without risking money during the stage where you will inevitably make the most mistakes. The key problem is not the tool, it's how traders use it. If you treat a demo account like a real one, with proper risk management and discipline, it can be extremely valuable. In the end, these are all misconceptions I personally experienced before realizing the truth. That's why I wanted to share them with you. If you enjoyed this video, please hit the like button and leave a comment below so I know. Thank you for watching, and I'll see you in the next video.